Just 2 days back, that is on 24th of November 2023, Nifty Midcap Index made an all-time high of 15,708. So, have you checked how well your midcap funds are performing? In today's video, we'll do a detailed analysis of one more popular midcap fund, that is Quant Midcap Fund, and see whether is it worth to invest in this fund or not. Earlier also, I had made a video on this fund. Link is attached in the I button and in the description. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. Let's start the video with the basic details of this fund. First, the AUM, that is the total asset under management, which is more than 3,200 crores, which I feel is on a lower side as compared to other funds in the category, while the expense ratio is 0.76%, which is at par when compared to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is Nifty Midcap 150 TRI. Now let's look at the fund's trailing returns. From the table, it is quite evident that the fund's performance has been quite good for 3 years and 5 years period. Here, we will not consider data of 5 years and more because Quant Fund House took over from Escorts in 2018 and have made major changes in its investment style after it took over more than 5 years back. Here, if you see, the fund's performance is a little poor for 1 year, and that is because of Hindenburg's report in January 2023. Again, if you see the performance for last 6 months and 3 months, it is quite good. Hence, from the above data, we can say that the fund's performance is quite good. Now let's look at the calendar returns and see how consistent the fund is in its performance. Here, we have data from 2014 to 2022, but we will consider only the data of 2019 to 2022, that is for last 4 years. Leaving aside the year of 2019, in the rest all 3 years, that is 2020, 2021 and 2022, the fund has been able to beat its benchmark and the category, and that too with a huge margin. Hence, from this data, we can say that the fund is quite consistent in its performance. Now let's also check the fund's performance for this calendar year. Here we have the data for the first 10 months of 2023, and these 10 months, the fund's performance has been better than its benchmark for only 4 out of these 10 months, which suggests that the fund's performance is not that consistent and great for this year of 2023. Now let's also quickly check the rolling returns. Here we have the rolling return data for 1 year, 3 year and 5 years. If we observe the 1 year rolling returns, the fund is able to beat its benchmark 89% of times with a negative return chance of 19%, with an average return of 24.21%. Now let's see the 3 years rolling return. Here if you observe, the fund is able to beat its benchmark 72% of times with an average return of 18.66%. Now finally, let's look at the 5 years rolling return. Here, the fund is able to beat its benchmark only 61% of times with an average return of only around 14.44% with almost no negative returns. Hence, from the rolling returns data, we can conclude that the fund's rolling returns are not that great, which indicates that the fund is an average performing fund. From the past performance data that we have seen till now, the trailing returns and the calendar returns are quite good, but the fund's performance in 2023 is not that great, whereas the rolling returns data also do not present a very great picture. So the question is, should we stop our investment in this fund? But always keep in mind that past performance data is not always an indicator for a future performance. So now let's see what we can expect from this fund in coming times. For that, we'll look at the fund managers and we'll also do a detailed analysis of the fund's portfolio. So firstly, let's look for the fund manager. Mr. Sanjeev Sharma has been managing the scheme from October 2019, that is almost from the inception of the scheme. He has been joined by Mr. Ankit Pandey in May of 2020 and Mr. Vasav Saigal in April of 2022. All three together have been managing not only the midcap fund but almost all other funds of Quant Fund House. So now let's look at the fund's portfolio and we'll start with sector-wise allocation. Here in the graph, if you observe, highest weightage is given to the energy sector, which is around 21%, followed by healthcare sector with around 14%, whereas capital goods, chemicals and automobile sector have a weightage of around 9% each. Right now, the portfolio seems energy sector heavy, And with such type of portfolio, there is always the chance of sector concentration risk. But Quant has a strategy of changing their funds and sector very fast. And hope with this strategy, this risk is also being mitigated. When we compare the sector allocation with the category, the allocation is quite different. Now let's look at the top holdings and portfolio allocation. Reliance Industries, Adani Power, and HPCL are the main stocks of the energy sector, whereas Linde India is the main stock of the chemical sector. Dixon Tech is the main stock of the capital goods sector. From the data available, it is very clear that the fund changes stocks very frequently. Take for example, after the Hindenburg report in January 2023, it had sold all the stocks of Adani Group. But again, if you see, it has now Adani Power in top 10 stocks in its portfolio. Now let's check the portfolio allocation. Here if you observe, mid-cap stocks form around 73% of the portfolio and rest 27% is allocated to large cap stocks. There is no allocation to small cap stocks. The portfolio is quite concentrated with just 28 stocks and top 10 stocks for more than half of the portfolio, that is 54% of the portfolio, whereas top 3 sectors contribute to around 45% of the portfolio with more than 21% coming only from the energy sector. This type of portfolios can suffer from all types of concentration risks, but the fund has a strategy of changing the portfolio very fast, which can mitigate this risk. The portfolio turnover is very high, in the tune of around 300%. Now let's see this table, which gives a very concise view of the portfolio. Here we have data of 1 year and is compared to its category average. It clearly indicates that the fund follows a blend style of investing with low yield stocks. The momentum of the portfolio is on a higher side with less volatility and liquidity. Now let's also check the portfolio changes made in last 1 month. Firstly, let's look at the stocks bought last month. As evident, the fund has added Linde India and Tata Communications in huge quantity, followed by Sun TV, CRISIL and Ipca Labs to its portfolio, whereas it has sold Dalmia Bharat, Sundaram Finance, Sundaram Fasteners, PNB and Indus Towers. So, from the portfolio overview and its data, we can say that the fund is following a blend style of investing and fund manager is frequently making changes in the portfolio to make the fund perform better. So before concluding what investors should do, let's quickly look at the risk parameters. Here we compare the parameters with the benchmark index and the category average. First, mean returns, that is the average return in a year, which is 34.74, which is quite high than both the category average and the benchmark index. Here, higher the value is better. Second, standard deviation, that is a tool to measure how much the returns are deviated away from the mean return, which in this case is 17.55, which is more than the category average and the benchmark index. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure the risk-adjusted return, which is 1.72, which is more than both the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to benchmark, which is 0.88, which is less than the category average. Here, lower the value is better. Fifth one, alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, it is 9.08, which is quite higher than the category average. Here, higher the value is better. From the risk parameter, it can be concluded that the fund is able to generate better returns than its benchmark and category, but with a little higher standard deviation. But its risk-adjusted return value is better than the category and benchmark, which is quite good for a mid-cap fund. Now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 111, which indicates that the fund outperformed 11% more than the index during this rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 72, which indicates that the fund declined 72% as compared to the index during this fall period. Here, lower the value is better. The upside capture ratio is quite good, whereas the downside capture ratio is okay. And this type of funds have a higher probability to outperform in uptrending markets. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I would request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to hit the like button and also subscribe to my channel if you are not done till now to watch such interesting videos in future also. Here, I would like to clarify that this is not a buy or a sell recommendation and one should take decision by himself or after consulting his or her financial advisor. This video I have made for educational purpose only and my aim is solely to provide a real insight into the fund's data. Please do not mistake this as a buy or a sell recommendation. So now let's look what investors should do. First, the existing investors. The fund's performance has been quite good in the past, but it had not performed that good in this calendar year. But this happens with almost all good performing funds, where they can have a period of underperformance. So without worrying much, I feel one can continue their investment in this fund. Quite a few people have shown their concern about the trading style of strategy followed by Quant. This style of investment becomes difficult when the AUM increases, but I feel that surely the fund manager would find a way out and see that the fund's performance is not hampered with the rising AUM. What do you feel? Do share your views in the comment box. Second, new investors. This has been a good and a consistent performing fund since few years, and I feel that one can start a new investment in this fund, ignoring the underperformance of this calendar year, which has been largely due to the Hindenburg crisis, and the fund has almost recovered from it. Hope to have a better performance in 2024. This is my personal opinion and I may be wrong also in coming times. So what do you feel? Please feel free to share your opinion in the comment section. Would love to know your views on this fund. I would like to add that presently I have Quant Midcap fund in my portfolio and is planning to hold till my next review. I will again try to review this fund after 6 to 7 months and check its performance. So stay tuned to my channel. Please subscribe to my channel if you have not done till now and also press the like button. Do check my older videos. Click the attached cards to watch the videos. Thank you and see you again in my next video.